Okay, so welcome back to our second part. Right. So in this session, in this part, we'll look at foreign currency markets, which we also call Forex Market, and we'll see what is an exchange rate, how currencies get traded. We'll look at conventions and terminologies in this market. We'll later on we'll talk about the determinants of exchange rate, and we'll look at purchasing power parity as one factor that can influence exchange rates, and then at the end I'll quickly mention some of the other factors that can potentially affect exchange rates. And at the end there is actually a homework for you today. So just like purchasing power parity, there is an interest rate parity. Okay, so when you go back home, I want you to look at interest rate parity, right? So the relevant factors are only mentioned in the module outline. So we'll talk more about interest rate parity in the seminar sessions. Okay, so what is a Forex market or foreign exchange market? So we know that each country has its own unique currency, right? The exception is the Eurozone, where all countries use the same currency, which is euro, right? But generally, each country has their own unique currency. But when it comes to international trade, right, then there is a need to exchange currencies, right? If you're a buyer in one country and you are buying goods from another country, right? Or simply if you are into import or export business, right? Then you will need to deal with the Forex market, because if you're buying goods from another country, you will need to pay the other party, which is in another country, in their local currency. So you need to buy their currency by selling your home or own currency. Okay. So international trade would require exchange of currency between importing and exporting countries for the transactions to take place. Similarly, when you invest in a foreign country, you will need to go to the Forex market again to acquire or purchase the currency of the country in which you want to invest. Okay, so the trading of currencies and bank deposits is what makes up this foreign exchange market. So it's abbreviated as FX, right? So this foreign exchange market, it's basically an over-the-counter market. Okay, so Forex market is basically an over-the-counter market. So quite a lot of you came from different countries, right? So when you were coming to UK, right? What did you do? You needed British pounds, right? Yeah. So what did you do? You went to a currency exchanger, right? Okay. It could be a bank, or it could be other brokers as well, right? Okay. And then you sold your home currency and you bought British pounds, right? Okay. So it involves buying, selling bank deposit denominated in different currencies. So you have a bank deposit, right? So you converted your deposit into another currency, right? So trades involves transactions in excess of $1 million, right? If you trade in foreign currencies, but you have done it on a local level, right? On your individual personal level, okay? But when typically, huge volumes of currencies are exchanged in this market. So according to an estimate, the Forex trading volume exceeds $5 trillion per day, right? So that's an enormous amount of money, right? Okay, $5 trillion per day. Okay, so typical consumers, which you are, right, buy foreign currency from retail dealers, which is what you did, right? Okay, so you went to your local retail currency dealer, and then you exchange your currency with another currency, okay? And you would typically do it for your purchases if you're buying goods from another country, if you're traveling to another country, right? Good. Okay, so again, there's a typo here. This is exchange rate, right? Right, so what is an exchange rate? It's a rate at which one currency is converted to another currency. A foreign exchange rate is simply the price of one currency in terms of another, right? So when you trade in the forex market, it will always involve two currencies, right? So here we have a diagram, right, that shows the amount of what is an exchange rate. It shows the amount of currency A that exchanges for 1 unit of another currency B in this example, right? The amount of currency A that exchanges for 1 unit of currency B, okay? So the currency that's represented as 1 unit is what we call the base currency, right? And the other currency that's quoted in terms of the base currency is what we call the terms currency, okay? Good. So there are two kinds of exchange rate transactions in the Forex market. So there are spot transactions, and then there are forward transactions. So we'll talk a bit more about forward transactions in the upcoming sessions as well. So what is a spot transaction? That is the prevailing exchange rate, converting one currency into another currency at the prevailing or the present exchange rate. So spot transactions involve near immediate exchange of bank deposit or currency and these are completed at the spot, right? Whatever is the exchange rate now. So Forex market is a risky market, right? Because and it also depends upon which currencies you're dealing with, right? Certain currencies are much more volatile than others, okay? So there's a lot of fluctuation throughout the day in the exchange rates. So it is a risky market, and it becomes especially risky if you're trading with illiquid currencies or currencies which have lower demand. Okay, so forward transaction is as the name suggests, right, is a transaction that takes place at some point in future, and the exchange rate is predetermined. Okay, so a forward transaction involves exchanging at some future date, right, at the forward rate, right? So this forward rate is predetermined. If you enter into a forward transaction, so let's say you're expecting to receive $1 million, right, in 3 months' time. So the dollar to pound rate can change over time in these 3 months, right? And especially what's happening with pound these days, right? Okay, so you want some sort of certainty. If you want some sort of certainty in terms of what will be the value or how much pounds you'll get uh, when you convert those $1 million in 3 months' time, right? So in order to get some sort of certainty, right, or to reduce your foreign exchange risk, right, you can enter into a forward contract. So today, let's say if you enter into a 3-month forward contract, you will, in the contract, you'll predetermine at what rate, what exchange rate will be applied to convert dollars into pounds in 3 months' time. Okay, so here we have a slide that shows exchange rates during the period from 1990 to 2016, right? So we have different currencies. On the top left, we have Canadian dollars, top right, British pounds, Japanese yen, bottom left, and euro, bottom right. Okay. So you can see there are lots of it is quite a volatile market. So looking at these graphs, can you determine which of these currencies is more volatile? Yen is more volatile. Anything else? Any other guesses? So the currency which has a lot more fluctuations, right? That is more volatile, right? Okay. So you can see all of these are all of these are volatile because all of these are quoted relative to relative to US dollars, right? So all of these show a lot of fluctuation over time, but some are more volatile compared to others. So Japanese yen appears more volatile, euro appears a bit volatile as well. And if you look at the British pounds, right? So in 2008, for example, when we had the financial crisis, so you can see, what happened to the British pound. Okay. Good. Okay. So let's talk about some of the let's look at the abbreviations and some of the conventions that we use in the Forex market. So here we have an example of exchange rate caught. So the British, the pound sterling dollar exchange rate, for example, is 1.312. Okay, and it's represented by a symbol pounds, GBP, USD, dollar, pounds, dollar, right? So what it means. So what this exchange rate 1.312 means? It means $1.312 per pound. Okay. So 1 pound, in other words, 1 pound is equal to $1.312. Okay. So the base currency in this case will be pound, right? Because that's presented in 1 unit. Okay. And the term currency is dollars. Good. Okay, good. So the quote, the quote can be direct or indirect, but you don't need to get confused in this direct or indirect, right? Because you will be shown by one, you'll be shown this figure, for example, right? 1.312. Okay? That's the exchange rate, right? Okay. So direct or indirect would depend upon from whose perspective you're looking at it. Whether you're looking at it from a US perspective or whether you're looking at it from a UK perspective. So if you look at this quote from a US perspective, right? So what will they see? The home currency price of 1 unit of a foreign currency, right? So if you are a US citizen and you're in US, right? How would you interpret this quote? This quote, right? Home currency price, right? In terms of 1 unit of a foreign currency for a US individual will be pounds, right? Okay. But if, for example, you look at the same quote from a UK perspective, right? What will you see? The foreign currency price of 1 unit of the home currency, right? Okay. So how much the foreign currency is in terms of 1 unit of the home currency. Okay, so direct and indirect would depend upon from whose perspective you're looking at it. And the relationship is very simple, right? So you can convert a quote, direct quote to an indirect and indirect to an indirect, right? Okay, because one currency is the base currency, right? One of the two currencies will be a base currency, which means 1 unit of that currency, right? Okay, so the reverse of that, inverse of that would be translating that in terms of 1 unit of another currency, right? Of the other currency, not another currency. Okay, good. So direct, what is a direct quote? Or we also call it the price quotation, the amount of foreign currency that can be bought for a certain unit of domestic currency. That's what we call a direct or price quote. Okay, so again, looking at it from a US point of view or US perspective, okay, so how much money or dollars has to be given up to buy 1 unit of another currency, which is £1. Okay, right? So from US perspective, the previous quote is a direct quote. Okay, because you're calculating how much money that is in dollars, right, has to be given up to buy 1 unit of another currency, which is the British pound. Okay, and if you look at it from the UK perspective, right, you'll call it an indirect. So indirect quote, we also call it the volume quote, right? So these terms can be changed interchangeably, right? So if you, for example, if instead of saying indirect quote, if I say volume quote, you should know that I'm talking about indirect quote, right? So what is an indirect quote? The quantity of foreign currency needed to buy a certain unit of domestic currency. So the same quote, right, from a US from a British citizen, from a UK point of view or UK perspective, will translate into the volume of dollars, that is the foreign currency, right, that can be bought or obtained per unit of home currency, which is British pound. Okay, so from a UK perspective, it's an indirect or volume quotation. So here I have a video as I was preparing, so as I was preparing this lecture, you can find information. Okay, so you have to log in. Okay, so do I need to block? Okay, so in Financial Times, these currencies are quoted. So there is a currency, so you can get a quote of any currency from the Financial Times. So these are quoted in the business press, right? So here you can see currencies and their exchange rates relative to other currencies are mentioned. Okay, so these are cross rates, right? We'll talk about cross rates as well. Okay, good. So you can find information about exchange rates from the business press, or you can go to a dealer, right? Okay, so the exchange rate, right, or the price quotation that we have, right? These are quoted by large international commercial banks that act as market makers, right? What's the difference between a market maker and a broker?
Can I guess?
Yeah.
Market makers determine the market and determine the price, and brokers take the price.
Okay. Anyone else?
Brokers, I think, have their stock also currencies that they can offer.
No, the opposite, right? So the broker just carries out the transaction, right? Whereas market makers have a stock; they invest their own money. They have a stock of assets, and in foreign markets, those assets will be these currencies, right? Okay. So as I mentioned earlier, this is a risky market, right? So the market. So international commercial banks trade in different currencies, and they act as market makers. So they offer you. So they have a stock of those currencies as well. So they buy and sell currencies at the same time. It's a very risky market, right? Okay, and it's very expensive, right? Because it's like liquid, right? It's cash, right? Holding cash in different currencies. Okay, it requires huge investments. So it's given its risk, right? It has to generate some sort of profit, right? Some sort of income. Okay, and how do market makers make profit? They offer two different types of calls: bids and ask, right? And they make money through the difference, which we call the bid-ask spread, right? So their trading strategy is very, very kind of simple, which is kind of universal, right? So sell at a higher price and buy at a lower price. Okay, so the amount they'll pay you to buy currency will be lower, right, than the amount at which they're going to sell the currency to you. Okay, so traders thus always quote two prices: a bid price at which market makers will buy the asset, and the asset in this case is a currency, right? And an offer price, or the ask, we also call it the ask price, right? At which the market maker are prepared to sell the asset or sell that currency. Okay, and the difference is through which they generate profit. Okay, but remember, so I'll come back to this. Okay, let's do the example first, and then we'll talk about the profit. Okay, so here we have an example of an exchange rate. Okay, so this is a quote between dollars and pounds. So the denominator currency here is pounds, right? So the base currency here is British pounds. And the quote is typically represented as we know, two prices: bid price and the ask price or the offer price. So the bid price is $1.5846 per pound. Okay, and the ask price is higher, 1.5851, slightly higher, right? Okay, so remember I told you you can convert this into one unit of another currency, of the other currency, right? So you can represent the same code in pounds terms as well. Okay. Okay. So these are represented per unit of dollars, right? Okay, good. So suppose in this example, suppose a Forex trader takes a telephone call and asks first the rate between two currencies. For example, that in this example we have sterling and US dollar spot rates. Okay, so we're not talking about forward rates, but whatever is the rate right now. So the rule we know of the trading, right? Buy at low price and sell at a high price, right? So what do we see in the green highlighted area? So the bid price is the price at which the dealer is prepared to buy British pounds. Okay, and we know that here in this example, pound is the denominator currency, right? Okay, and then the offer price is the price at which the dealer will sell British pounds. Okay, and what I've done here in the lower part, right, is the reverse of it. Okay, representing the British pounds per unit of dollar. Okay, so the trader, so in the second row, so dollar is the denominator currency, right? So trader buys $1 by spending 0.6309 pounds and sells $1 for 0.6311. Again, you can see buys at a lower price, right, and sells at a higher price. Okay. So before we actually go any further, so let me just quickly show you this. Where did it go? So this historic exchange rate between British pound and dollar, right? So it's a century. So it's called a century of decline for British pound, right? So pound has declined over the last 100 years or so against the dollar. So at the beginning, so we're starting in 1992, and the value of pound was, so £1 was equal to $4.46 at that time. Okay, what is the value today? 1.1, around 1.11 or 1.07 or something like this, right? Okay. Okay. So what I want you, so I'm showing this to you, but when you go back home, the link is in the slides, right? When you go back home, what I want you to do is to note down the key moments, right, in the history. So in for example, here in 1925, Winston Churchill returns sterlings to gold standard at the pre-war rate of 4.86 to the pound. Okay, so that's so what I want you to do is to note the events and note down how does the exchange rate respond to that event. Okay. So these events will come as the time lapse. So when you do it, you can just pause it at different points and note down the events as well. So you can see over this period, right, it remained relatively flat, right? Okay, it's like 1940s, right? Most of 40s up till 50, right? Okay, so you need to know what happened during this time, and white remains relatively stable, and then it dropped all of a sudden. Again, period of relative stability, right? Okay, I'm just going to move a bit forward, right? Okay, so it dropped here. That's around 80, 86, 87, 87. Right. Okay. Good. So you should look at the event and how does the market respond to it. Okay. Good. So over a century, pound has lost significant value against the dollar. Okay. So remember we talked about that Forex market is risky and the market maker need to make some sort of profit given the riskiness of the market. So and one way by which they make some profit is through the difference in the bid and ask prices, which we call the spread, right? Okay, so but this difference, right? The spread is not the profit that the dealers earn, right? Well, so this will only be the profit when two transactions take place at the same rate. Okay, two opposite transactions take place at the same rate. So a pair of trades is transacted at each of the quoted bid and ask prices, right? Only then it will translate into a profit, right? So for example, if you go to a Forex trader and let's say buy another currency, right? It's only one leg of the transaction, okay? So let's say you are buying currency A, right? And if someone else at the same rate, at the same cost of bid and ask, someone else sells currency A to dealer, only in that case the spread will be equal to profit. Okay, so a pair of transactions should take place for this profit to be equal to the spread. So typically, you know, it's not the pair of the transaction doesn't necessarily happen at the same time at the same rates. Okay, so the spread is not equal to profit in a typical market transaction. So how this forex is foreign exchange rate is determined? That you know the basic economic principle of demand and supply applies here as well. So demand and supply in forex market are constantly changing. As a result, the rates quoted in the market are also constantly changing. Okay, so here we have an example of a different type of exchange rate, which we call the cross rates. Okay, so so you need cross rates for currencies that are less regularly traded or which have lower demand, right? Okay, so as an example, we'll say we have sorry about this. Okay, so as an example, we'll take New Zealand dollars and the Mexican peso. So what we need to do is to calculate the exchange rate between New Zealand dollars and the Mexican peso through another currency, through another common currency, right? Okay, so the common currency uh, that has that. So if we have another common currency, right, that trades or that has a cost for both the New Zealand dollars and the Mexican peso, then we can use that information to calculate the exchange rate between these two currencies. Okay. Right. So the common currency is what we refer to as the vehicle currency. Okay, so continuing with the example, so here we have these two currencies quoted against a common currency, which in this example is British pounds. So both of these currencies are quoted in pound terms. They may not be quoted directly against each other, right? Okay. But using this common denominator currency or vehicle currency, we can calculate the cross exchange rate between these two currencies as well. So what we have here is the bid and ask prices for New Zealand dollars per pound, and similarly we have bid and ask prices for Mexican pesos per pound. So in this example, which one is the vehicle currency? The pound, right? That's the common currency against which both of these currencies are quoted. So the bank's bid and offer rates for New Zealand dollars. The base currency in Mexican peso, the terms currency will be calculated as if the following two transactions were taking place. Okay, so you'll convert. Okay, so if you want to convert New Zealand dollars into Mexican pesos, right? So what will you do? You will first buy British pounds. You convert New Zealand dollars into pounds, right? Okay, and then with the pounds that you have, you will buy Mexican pesos. Okay, so the two transactions will take place. So here we do the following two transactions, right? The codes are given. So in the first transaction, what will the customer do? Customer will sell New Zealand dollars and buy pounds, right? Okay, right? So when the customer will sell, right? What will the banks do? They'll go for the ask or offer rate. Okay, so you convert New Zealand dollars into pounds. That's the first transaction. And then once you have the pounds, right, you sell pounds to buy the Mexican pesos, right? And the dealer will buy it at the bid price. Okay, so you can see in this case, dealer makes money on both transactions. Right. So when you convert New Zealand dollars to pounds, this is the exchange rate, right? The offer rate or ask rate, and then you sell pounds to get Mexican pesos, which is this, right? So now you know that New Zealand dollars, this rate at this rate, right, is equal to Mexican pesos at this rate. And then you can calculate or represent that on a per unit of one of these currencies. So here, these are represented in New Zealand dollars. So one New Zealand dollar is equal to 9.6651 Mexican pesos. Okay. So all you have done is divided this by this rate. Okay. Good. Okay, so this is the reverse. What I've done here is that in this case, customer wants to sell Mexican pesos to buy New Zealand dollars. Earlier example was sell New Zealand dollars to buy Mexican pesos, right? So it's exactly the same transaction, but where I've switched the currencies. Okay, so it's exactly the same process. So if a customer wants to sell Mexican pesos to buy New Zealand dollars, what is the first transaction? Sell pesos and buy pounds, right? And then sell pounds to buy New Zealand dollars. And using these cross exchange rates, using these exchange rates of the two currencies relative to the British pound, you can determine the cross exchange rate. Okay, so we know that exchange rates change over time. So when the currency of your country appreciates relative to another country, right? When the currency of your home or your country or home country appreciates relative to a foreign country, your country's goods prices, they increase abroad, and the foreign goods become cheaper for you. Okay, so for example, think about let's say buying something in dollars, right? If the pound appreciates, what does it mean? Which means with the same £1, now you're able to buy more dollars, right? Okay, so you can buy more goods with the same amount of pounds, right? Because in dollar terms, you will end up having more dollars. Okay, so the foreign goods will become cheaper, and your own or home country's goods will become more expensive if your home country's currency appreciates in value. So here we have an example, right? In 1999, the euro was valued at $1.18. And in on June 16, 2016, it was valued at $1.132. Okay. Okay, so these are quoted in pounds and in euros terms, right? 1 euro was equal to 1.18. Now 1 euro is only worth 1.132. Okay, so which means euro has depreciated. You can calculate the rate of depreciation by using the basic formula, right? Which is the new rate minus the old rate divided by the old rate. Okay. If one currency has depreciated, by default it means other currency must have appreciated, right? So similarly, you can calculate the rate at which dollar has appreciated over this period. Okay, so here what I've done is I've calculated the appreciation in dollar, right? So how did I get these numbers, right? These are reverses of this, right? 1 over these numbers, right? Okay, so I have mentioned this here, right? How did I get 0.89? 1 over 1.11, and 0.847 is equal to 1 over 1.18. Okay, so what determines the exchange rate, right? So one of the things we have already looked at, right? Uh, you know, your currency can either appreciate or depreciate, right? And appreciation or depreciation means a different exchange rate, right? So how these exchange rates, or what are the factors that affect these exchange rates? So typically in a market, in an open market, you would expect these rates to change as the relative demand and supply of a currency changes. Supply of a currency in a short term is relatively fixed, right? Okay, so supply of a currency in the short run is fixed. So what will determine is the relative change in demand of the currency. Okay, so for example, an important concept that derives the forces of supply and demand is what we call the law of one price. What is this law of one price? Anyone? What is law of one price? So it doesn't matter, right, where you buy a good, right? As long as it's the same good, identical good, it should have the same price, right? That's law of one price. So the price of an identical good will be the same throughout the world, regardless of which country produces it, right? So that's law of one price. But there is an implicit assumption here. What is that assumption? the transportation costs, there are no transportation costs, for example, right? Okay, and there are no barriers to trade as well, right? Okay, good. So there's kind of free market, right? So world is like one market, and you can buy goods from any country in the world. Okay, so let's look at an example, right? So this law of one price will influence the exchange rate. Okay, so here we have American steel that costs $100 per ton, right? So in America, you can buy a ton of steel for $100, whereas in Japan, you can buy the same ton for 10,000 yen. Okay, so the quantity is the same. Okay, we will still have time, right? Okay, there's still 10 minutes in our session. Right, okay, so given these given this information, we can work out what should be the exchange rate between yen and dollar, right? So according to law of one price, 1 ton should cost the same in America, and it should cost the same in Japan, right? So if we take the given information, so in US it costs $100, in Japan it costs, and if the exchange rate is 50 yen per dollar, right? Okay, so this would translate into 5,000 yens, right? So using the rate, so if because in Japan the rate is 10,000 yen, so that would translate into a cost of steel, 1 ton of steel in Japan in dollar terms as $200, right? So this means, if this is the case, this means that the law of one price would not hold, right? Okay, so to ensure that the law of one price holds, 1 ton of steel should cost the same in the two countries, $100 each, right? And using this law of one price, we can determine what should be the exchange rate between pounds and yens. Sorry, between dollars and yens. Okay. So if the law of one price holds, this dictates that the exchange rate between the two currencies should be 100 yens per dollar. Okay. So you can see if the law of one price holds, so if, for example, this is the original exchange rate, right? And we know in this case that the law of one price does not hold. So the exchange rate must move in a direction that would equate the two, right? That would make sure that the law of one price holds in the two countries. Okay, so what if the exchange rate was actually $80 yens per dollar? Would the exchange rate be able to hold? The answer is no, because in that case, the law of one price is violated, right? So the exchange rate must move in a direction that would ensure that the law of one price holds in the two countries. So what is this theory of purchasing power parity? So it states that exchange rates between two currencies will adjust to reflect any changes in price levels between the two countries, right? So for example, if domestic price levels increase by 10%, okay? So in other words, you can think of this as inflation. If inflation in a country goes up, is around 10%, which in prices in that country increase by 10%, right? The domestic country's currency must depreciate by 10% in order to ensure that the law of one price holds. Okay? So application of the law of one price levels will affect the direction in which the exchange rates should move. If prices get affected in a country, the currency, right, the exchange rate will also change in the direction that it would ensure that the law of one price holds. But this law of one price holds or works only in the long run. It doesn't work in the short run. So what we have here is this graph, right? Is this figure that shows the relative price levels between US and UK and the exchange rate between pound and dollar, right? So you can see that in the short run, if you take any so in the first period, right? In this period, you can see the two move together. But in this period, right, it deviates, right? But in the long run, it should hold, right? Only so the law of one price holds in the long run, but not in the short run. Right, okay, so other factors that can potentially affect exchange rates in the long run are as follows. So we looked at price levels, right? We already looked at price levels. Okay, if price increases in domestic country or home country, right, its currency must depreciate to ensure the law of one price. Then we have trade barriers. If there are more trade barriers, so as I said earlier, so the law of one price comes with certain assumptions. One of those is that there are no trade barriers. If there are trade barriers, then the law of one price will not hold, right? Because you can't trade between countries. So the more trade barriers, right? Then if there are higher trade barriers, then the currency, your home currency, will appreciate, right? Because putting these barriers, by putting these barriers, you're insulating yourself from the law of one price, right? Okay, good. Right, just one more. Yeah, yeah. Okay, good. So import demand, as the demand for foreign goods increases, right? Your currency will depreciate in response to that. If your export demand increases, if you are supplying or selling more goods to foreign currencies, which means the demand for your currency will increase, so it will increase in value. The productivity has the same effect as the export. If you're producing more, you're more likely to export more, and as a result, the demand for your currency will increase, which will result in appreciation. So as I mentioned right at the beginning, so interest rate parity is similar to purchasing power parity. So I want you to look at it, and we'll discuss that in more detail in the seminars. Okay, great. Good, I'll see you in the seminars.